I'm Tony Shepard, and today I want to walk through something that sounds boring until it suddenly costs somebody real money. Homeowners, retirees, taxes, IRS rules. I know, not exactly the kind of stuff people sit around excited to talk about. But this is one of those topics where a small detail can turn into a very expensive surprise. And the part that bothers me is that most people don't get caught because they're trying to cheat the system. They get caught because the system has a lot of little rules, deadlines, thresholds, and technical requirements that nobody explains in normal language. So let's talk through it plainly. If you own a home, if you're retired, if you're getting close to retirement, or if you're helping a parent deal with taxes, there are a few things you really need to understand going into 2026. Some of them are penalties, some of them are deductions, some of them are benefits people miss simply because they never knew they had to ask for them, and one of them has to do with selling a home you may have owned for decades and still getting hit with a tax bill that can feel completely unfair. Let's start with the first one, because this catches a lot of newly retired people. When you're working a regular job, taxes are usually handled in the background. Your employer takes money out of every paycheck: federal tax, Social Security, Medicare, maybe state tax too. You might not like it, but it happens automatically. Then retirement comes along and suddenly your income comes from different places. Social Security, a pension, IRA withdrawals, a 401k, investment income, maybe rental income, maybe a part-time job. And here's the problem: those sources don't always withhold enough tax. Sometimes they withhold nothing unless you tell them to. So you get to tax season thinking everything is fine, and then you find out you owe the IRS more than expected. And if you didn't pay enough during the year, the IRS may add an underpayment penalty on top of it. That's the part a lot of people don't realize. The IRS doesn't just care that you pay your tax by April. They generally expect tax to be paid throughout the year. That can happen through withholding or through estimated tax payments. And estimated tax payments are usually due in quarterly installments. For retirees, this can feel strange because nobody sits you down and says, "Hey, the paycheck system stopped. Now you may need to manage this yourself." So here's the simple version. If you owed more than $1,000 when you filed last year and your withholding is not covering enough this year, you may need estimated payments. There are safe harbor rules that can help you avoid penalties. In many cases, paying 100% of last year's tax can protect you, or 110% if your income is higher. But you have to plan for it. And there is a waiver that may help certain retired taxpayers who recently retired after reaching age 62, but it isn't something you should just assume will happen automatically. It has to be handled correctly. So the practical takeaway is this: don't wait until April to find out whether enough tax was paid. Look at last year's return. Look at what's being withheld now. If you're taking IRA withdrawals, pension income, or investment income, make sure the withholding actually matches your situation. Because a few minutes of planning can save you from paying a penalty for something you honestly didn't know had changed. Now, the second issue is one people really don't like hearing about: Social Security taxes, because most people think about Social Security in a very simple way. You worked, you paid into the system, you retire, you collect your benefit. That sounds like it should be the end of the story, but it isn't. Depending on your income, part of your Social Security benefits can be taxable, and not just a tiny piece. Up to 85% of your benefits can be included in taxable income. Now, that does not mean the government takes 85% of your check. That's an important distinction. It means up to 85% of the benefit can be counted as income on your tax return. Still, that can create a real tax bill. The IRS looks at something called combined income, sometimes called provisional income. That number includes your adjusted gross income, any tax-exempt interest, and half of your Social Security benefits. That total determines how much of your Social Security may become taxable. For single filers, the key thresholds are $25,000 and $34,000. For married couples filing jointly, the key thresholds are $32,000 and $44,000. And here's the part that makes people angry. Those numbers are old, very old. They were not built for today's economy. So what used to affect a smaller group of higher income retirees now affects a lot more people. And that's why someone can feel like they're living on a pretty modest retirement income, but still get pulled into Social Security taxation. Let's make it simple. Say someone receives Social Security and also takes withdrawals from a traditional IRA. That IRA withdrawal counts toward combined income. Half of the Social Security benefit also gets added into the formula. So even if the person doesn't feel wealthy at all, the math can push them over the threshold. And once they cross those thresholds, more of the Social Security benefit can become taxable. That's why retirement income planning matters. It's not just how much money you take out. It's where the money comes from. Traditional IRA withdrawals can affect the formula. Roth withdrawals generally don't affect combined income the same way. Tax-exempt interest can still count for this calculation. That's the kind of detail people miss. And when they miss it, the tax bill shows up later. Now, there is a newer senior deduction that may help some older taxpayers. For For eligible taxpayers age 65 and older, there's an additional $6,000 deduction available from 2025 through 2028. For a married couple where both spouses qualify, that can be $12,000. This is separate from the regular additional standard deduction for seniors, and it phases out at higher income levels. So this is not a magic fix for everyone. But for some people, it can lower taxable income and soften the impact of taxes on retirement income. The key is making sure it gets claimed correctly, because newer tax changes can be missed if somebody is using outdated software, rushing through a return, or assuming the program caught everything. So if you're 65 or older, this is something to ask about directly. Don't just assume, ask the question. Did we apply the new senior deduction if I qualify? Ask the question. That one question can matter. Now let's talk about homeowners. For years, one of the big frustrations for homeowners in high-tax states was the SALT deduction cap. SALT stands for state and local taxes. That includes things like property taxes and state income taxes. For a while, the cap was $10,000. So if someone paid $18,000 in property taxes and state taxes, they could still only deduct $10,000 federally. That was a big deal in states where property taxes are high. Places like New Jersey, New York, California, Connecticut, Illinois, Massachusetts, you get the idea. That means some homeowners who got used to taking the standard deduction may need to rethink their filing strategy. Because here's the trap. Under newer law, the cap was raised significantly for certain years. A lot of people switched to the standard deduction when itemizing stopped making sense. Then the rules changed, but their habits didn't. They did that for years. So they keep doing what they've always done, even though itemizing might now save them money. Standard deduction versus itemized deductions. That's why homeowners need to run both numbers. Not guess, not assume, run the numbers. Not assume. If your state and local taxes, mortgage interest, and charitable contributions add up to more than your standard deduction, itemizing may be better. But if nobody checks, you may never know. And that's the theme here. They just sit there. A lot of these tax rules don't jump up and wave at you. You either know to check them or you don't. Now, another major change affects energy credits. These credits could be valuable because a credit is not the same as a deduction. A deduction lowers taxable income. For years, federal energy tax credits helped homeowners with things like solar panels, energy-efficient upgrades, and certain clean energy improvements. A credit can reduce your tax bill dollar for dollar. That's why people paid attention to them. One of the most important phrases here is placed in service. But some of those credits changed or ended under newer legislation, and the deadline details matter. That means the improvement generally has to be installed and ready for use, not just paid for or contracted. And that distinction can be painful. But if the project isn't completed by the required deadline, the tax credit may not apply. Because someone might sign a contract, pay a deposit, and think they're safe. But if the project isn't completed by the required deadline, the tax credit may not apply. Permits, contractor delays, inspection backlogs, weather, supply problems. The homeowner may have done everything right, but the tax rule looks at the service date. So if you're dealing with any major home improvement that depends on a tax credit, don't rely on what a salesperson says, check the deadline, and get documentation. Don't rely on what a salesperson says, check the actual tax rule. Ask what placed in service means for that specific credit. Because when tax season comes, the IRS is not going to care that the salesman told you, yeah, you should be fine. Now let's get to the home sale issue. When you sell your primary residence, the tax code may let you exclude part of your gain. For a married couple filing jointly, it can be up to $500,000. This is the one that can really shock people. For a single filer, the exclusion can be up to $250,000. That sounds simple, but there are tests. And the biggest one for older homeowners is the use test. That sounds easy if you owned the house for decades, and that's where seniors can get caught. In general, you must have used the home as your main home for at least 2 of the 5 years before the sale. But the IRS is not looking at the whole history of your life in that home. It's looking at the 5-year window before the sale. Let's say someone bought a home 30 years ago. Raised a family there, paid the mortgage, maintained it, lived in it for most of their adult life. Then their health changes. Maybe they move in with an adult child. Maybe they go into assisted living. The old house is still theirs. They still think of it as home. Maybe they move in with an adult child. Maybe they start spending most of the year somewhere warmer or easier to manage. Then they sell, and they assume the home sale exclusion applies. But if they fail the use test, the exclusion may be reduced or lost. That can turn into a very large tax bill, and that feels wrong to people. Because emotionally, that was their home, no question. But tax rules don't run on emotion, they run on definitions. Main home, ownership test, use test, 5-year period, 2 years of use. That's the language that matters. There may be partial exclusions in certain situations, including health-related moves or unforeseen circumstances, but documentation becomes very important. If a move was related to health, you want records, you want dates, you want proof, You want a tax professional who understands the rule before the home is sold, not after, because after the sale, you may have fewer options. You want a tax professional who understands the rule before the home is sold, not after, because after the sale, you may have fewer options. So if you or someone in your family owns a home they no longer live in full-time, count the months. Seriously, count them. How many months during the last 5 years was that home actually used as the primary residence? If it's close to 24 months, that matters. If it's below 24 months, that matters too. And if a sale is coming up, timing can be the difference between qualifying and not qualifying. This is one of those things people should check before listing the house, not after closing, before. Now let's end with something that can actually help homeowners right away, but here's the key point. These benefits are often not automatic. Property tax exemptions. Almost every state has some form of homestead exemption, senior exemption, freeze, deferral, or property tax relief program. The details vary by state and county. Some are based on age, some are based on income, some are based on disability, some apply to school taxes, some freeze the assessed value, some reduce the taxable value of the home. You may have to apply, and a lot of people never do. They turn 65, keep paying the same property tax bill, and never realize they qualified for a reduction. That can go on for years. And in some states, you may be able to get limited retroactive relief, but not always. So the practical step is simple. Call your county assessor, appraisal district, or local property tax office. Ask what senior exemptions or homestead benefits are available. And sometimes the simplest paperwork is the thing people miss the longest. And in some states, you may be able to get limited retroactive relief, but not always. So the practical step is simple. Call your county assessor, appraisal district, or local property tax office. Ask what senior exemptions or homestead benefits are available. Ask about deadlines. Ask what documents are required. Usually it's proof of age, proof of ownership, and proof that the home is your primary residence. This is not glamorous. It's not exciting, but it can save real money every single year. So let's bring this together. The tax system is not just one big rule. It's a pile of smaller rules that interact with each other. Estimated taxes can catch newly retired people off guard. Social Security taxation can surprise people who thought those benefits would be tax-free. The senior deduction may help, but only if it's properly claimed. The SALT cap change may make itemizing worth another look. Energy credits depend heavily on deadlines and service dates. The home sale exclusion can disappear if the use test is not met. And property tax exemptions can sit unclaimed for years because nobody told the homeowner to apply. That's why the safest approach is not panic, it's awareness. Slow down. Check the rules before you make major moves. Before you sell a home, before you take a large retirement withdrawal, before you assume a tax credit applies, before you file the same way you filed last year. Because in taxes, the expensive mistakes are often not dramatic, they're quiet. They happen because of one date, one form, one threshold, or one assumption. And if there's one thing to take away from all of this, it's this. Don't wait for the IRS to explain how to save money. That's not really how the system works. You have to know what questions to ask. Don't wait for the IRS to explain how to save money. That's not really how the system works. And sometimes asking the question early is what keeps a small rule from becoming a very big bill.